everyone, welcome to this session dedicated to Luxembourg as a prime location for alternative investment. My name is Michael Ayachi. I am a tax partner at KPMG in Luxembourg, soon to be relocated in the US to lead our Luxembourg Tax Center in New York. I'm very pleased to be joined by my colleague Thomas Adamkiewicz, an associate partner from our alternative investment group based in Luxembourg. Now, let's have a quick look to the agenda. No big surprise. We will go through a quick overview of Luxembourg, going into the specific investment vehicles that are available in Luxembourg in an alternative investment context, obviously covering the specific tax features of those funds, but as well as the entities below the funds. But we also would like to tackle some more recent topic being mostly related to the Anti-Tax Avoidance Directive 1 and 2. Now, just a brief overview of Luxembourg in an investment fund context. So whilst Luxembourg is a quite small country with a population of 640,000 inhabitants, it has a very strong economy, which is mostly focused on the financial sector, and the investment funds contribute a lot to that. So these are a few facts that we collected from the Luxembourg Association for Investment Funds, where you can see the evolution of net assets under management of funds being located in Luxembourg. And as you can see in terms of recent figures, by mid of 2021, we were exceeding 5 trillion euro of assets under management in funds located in Luxembourg. Now, when we look to the number of funds units, and as well as net asset evolving over time on the right-hand side of the structure, you see a consistent increase, basically, in terms of fund units. Now, when we look to 2020, around the COVID period, we could see like a little drop of, funds unit and fund having been launched in Luxembourg. But while we can see that that little drop, the net asset value under management has still going up. Now, I'd just like to pause here and ask Thomas, basically, how concretely COVID has impacted the investment fund industry in Luxembourg.
Yeah, thank you, Michael, for the introduction. And obviously, the COVID situation had some implication in terms of deals and transactions in Luxembourg, which is the case also in the other country in the world. And what we have seen is that as from September 2020, a little bit a drop on that, but this drop has been then ended around 2021. And this COVID situation is still providing some, let's say, complication in terms of transaction. But the Luxembourg has been also able to maintain and get still an increase of the vehicle for the alternative investment industry, thanks to, let's say, Brexit. So as you know, with Brexit, the UK left the EU, meaning that as from 2018 and 2019, we have seen some, let's say, migration, transfer of some vehicles from the UK to Luxembourg, which is one of the preferred destinations for EU relocation. So basically, what it was, let's say, required is to get a EU jurisdiction to get access to the EU market. And then Luxembourg has been one of the preferred jurisdiction.
Thank you, Thomas. But can you please expand on what are basically the key, drivers around the attractiveness of Luxembourg for the fund industry?
Thanks, Michael. And Luxembourg has developed an appropriate and accurate system for more than 30 years. What does it mean? It means that over the 30 years, Luxembourg has developed a system in order to ease the service provider to provide the best tax legal advice. And the bank also are well informed about the alternative investment industry. Also, in Luxembourg, you can speak German, English, and French, which is also very helpful when you need to draft the legal documentation in relation to the setting up of a Luxembourg vehicle. Finally, you have an easy access to the Luxembourg regulator, meaning that you can have a meeting and discuss about your Luxembourg vehicle that you want to set up in order to make sure that you will get a quick approval.
Thank you, Thomas. And I guess also the wide range of investment vehicle is also playing for the attractiveness of Luxembourg. Speaking of which, can you a little bit expand of the type of vehicle available in the alternative investment world?
Yes, for sure, Michael. Indeed, the range of diverse vehicle available in Luxembourg is also very helpful for alternative investment clients because they will have access to a full range of different type of vehicle in order to fit with the profile of their investor and also would fit with the specific asset class that they want to invest in. So typically you have the UCITS, which are for the public, and then you have the non-UCITS, so-called the alternative investment vehicle, for which it will be a closed-ended type, but could be also open. And the alternative investment vehicle would have to meet some risk diversification, but you have also access to the private equity fund, to the real estate fund, and hedge fund, which is not the case for the UCITS. Having said that, you have different type of vehicle. So if we go to the next slide, so you have on the bottom left side, you have the UCITS, which are the more regulated vehicle, and then it goes to the SCSP, which are the less regulated vehicle, and then you have a range of different type of vehicle, CCAR, CIF, RIF, in order to fit again with the specific profile of your investor and also with the asset class that you want to invest in. Going forward, you have within the alternative investment vehicle, different type of vehicle as mentioned on the next slide. Typically, for the alternative investment industry, you will opt for a CCAR, CIF, or RIF vehicle. And for each type of vehicle, there will be some specific requirements depending also on the investor profile.
Okay, so thank you very much, Thomas. So if I understand well, based on what is disclosed on the slide, so CCAR does not have any diversification requirement, but it needs to invest into risk-bearing securities. So that would typically be a vehicle which we can use for private equity, I suppose. A CIF is a fund vehicle which can invest into a more wider range of assets, but has a diversification requirement because it cannot invest more than 30% of its net assets into the same issuer. Very well. And a RIF is working a bit similarly to a CIF, except that it doesn't necessarily have that same level of risk diversification. But a RIF is de facto, and we will see that managed by a alternative investment fund manager, which is not necessarily the case for a CIF. Okay, so now thank you very much, Thomas, for giving us a brief overview of the different fund vehicles that we have in Luxembourg. So as we go to the next slide now, we will enter into the more taxation aspect. I will first start by giving a brief overview of the corporate tax system. So what are the basic corporate kind of tax that we have in Luxembourg? So a corporation are subject to, let's say, an aggregate corporate tax of 24.94% as of today. So that's the rate effective as of today. So that rate is actually slightly higher than the average corporate income tax rate of Europe. It's a combination of what we call a corporate income tax, which is levied by the state, so at federal level, and what we call a municipal business tax being levied by municipalities. And the rate of the municipal business tax in Luxembourg City is 6.75%. There are exemptions possible for certain income, like the participation exemption, which we will expand in a few minutes. As well as income derived from assets which are located in country where we have a double tax treaty. For example, asset located in a branch in a country where we are protected by a double tax treaty. So we would typically apply an exemption here. So we also have a very specific tax which applies to companies in Luxembourg, which you would not necessarily see in other countries, which is the so-called net wealth tax. The net wealth tax is a tax which is levied on the net asset value of a company at a rate of 0.5%. And on the so-called unitary value, which is basically the net asset value, but on a fair market value basis. That rate would drop to 0.05% for a unitary value exceeding 500 million euro. There are some exemption available on certain assets, for example, participation in subsidiaries qualifying for the participation exemption. There is also a possibility to build up a so-called net worth tax reserve out of profits to basically reduce your net worth tax. I will not enter into the detail, but that's also a possibility to kind of mitigate the company's net worth tax exposure. And then last but not least, in terms of withholding tax, in Luxembourg, there is in principle no withholding tax on payment of interest as well as payment of liquidation proceeds, but we do have a 15% withholding tax on distribution of dividend unless we can apply the participation exemption or a double tax treaty. Now, as we go to the next slide, let's dig a bit more into how the participation exemption works in Luxembourg. So basically, the participation exemption is the transposition of the parent subsidiary directive, which you also have in other EU member states, whereby we would, avail for an exemption of dividend and capital gain from subsidiaries, not only actually located in the EU as required by the parent subsidiary directive, but as well as subsidiaries outside of the EU. So Luxembourg basically expanded the broad of entities to which that regime would be applicable. But in that case, as far as non-EU companies are concerned, those companies would need to meet a comparable taxation test. So basically being taxable on a similar basis than what it would be under Luxembourg rules at a so-called CIT rate of 8.5%, that would basically meet that test. So now if we look at the specific requirement in terms of participation threshold, we need to look at the participation being held for at least 12 months in the subsidiary. The holding must be 10% in the capital or an acquisition cost of 1.2 million for dividend exemption or 6 million for capital gain. It's important also to note that while capital gain are exempt, capital loss are also deductible on disposal of a given participation. So now, as we go to the next slides, these were basically the main features applicable to, I would say, regular corporation in Luxembourg. Thomas, can you please give us a bit more color as to what is basically the tax system applicable for funds in Luxembourg?
Yes, for sure, Michael. So in Luxembourg, the Luxembourg fund vehicle are most of the time exempt from tax in Luxembourg, meaning that they should not be subject to the so-called corporate income tax. Instead, they should be subject to a subscription tax at a rate of 0.01% or 0.05%, computed on their net asset value on annual basis. So, except some vehicles like the C-car, which benefit from some exemption on some specific assets. So in general, a Luxembourg vehicle would be subject to the subscription tax and will be exempt from income tax and should be also exempt from net worth tax, of course. Then they should have no withholding tax also on cash repatriation to their investor. Finally, depending on the type of vehicle and on the tax treaty applicable, you might benefit also from the tax treaty provision. Indeed, Luxembourg benefits from an extensive treaty network, and the Luxembourg fund vehicle may benefit from the treaty network depending on the jurisdiction involved, and this should be reviewed and carefully monitored on a case-by-case basis. Also, in addition to the corporate income tax to consider, you have also the VAT tax regime. The VAT tax regime is applicable to the Luxembourg vehicle. Now, there is a specific exemption on management service provided to a fund, meaning that management service provided and rendered to a Luxembourg fund will be exempt from VAT. Of course, this will need to be reviewed on a case-by-case basis in order to make sure that the scope of the management services agreement is in line with the VAT exemption. In addition to that, you have some partial exemption on VAT, like depository services, where you will have a 40% VAT rate to be applicable. Now, what we can also think about taxation, it's ATAD 1 and ATAD 2. So, Michael, can you say whether or not ATAD 1 and ATAD 2 has any tax implication for the Luxembourg vehicle?
So thank you, Thomas. So before entering into the detail of the implication of the anti-tax avoidance directive to the fund industry, let's have a quick look at basically the 5 pillars which are tackled by that directive. So we look at providing a limitation of deduction of interest on the so-called exceeding borrowing costs. We look at hybrid mismatches. We look at general anti-abuse rule, control foreign company rules, and exit taxation. A lot of those provisions didn't exist before in Luxembourg. So these were new things which Luxembourg had to implement in light of that directive. So now if we look to the interest limitation rules, so basically how they work, you would be looking at restricting, denying, exceeding borrowing costs, which basically exceed 30% of the tax EBITDA of the company. So the company would be able to deduct exceeding borrowing cost up to 30% of its EBITDA. So that it's applicable for, I would say, regular, Luxembourg companies. Now, would that have an impact for a specific fund vehicle? In principle, not when it comes to a regulated fund, for example, an alternative investment fund managed by an alternative fund manager or a UCITS, for example. But these are generally entities which are in any case not subject to tax, so the impact would not be that important. But it needs to be mentioned that other vehicle like securitization vehicle can be in scope of the interest limitation rules. So basically, case by case as the application of those rules to the fund industry. So the other provision that we would like to develop with regard to the anti-tax avoidance directive is the hybrid mismatches. So typically hybrid mismatches will look at a payment which is a deductible payment in one country and which is seen as an exempt dividend in another country. So there is a mismatch in terms of the qualification of the payment. Other situation would be an entity which is seen as a corporation on one side and a disregarded entity. So that would typically be what we call the hybrid entity. So these mismatches needs to arise between what we call associated enterprise. So this needs to be within a group, so to say. And the threshold to assess whether there is an associated enterprise, here we look at a 50% threshold of ownership, directly or indirectly into that given entity for hybrid entity, and a 25% threshold for hybrid instrument. Now, if a shareholder act together with another shareholder into an entity, you would need to aggregate the shareholding percentage of those shareholders to assess basically those specific thresholds. And when you think about a fund, obviously you have multiple investors into a fund, and a fund can typically be potentially seen as a hybrid entity because a fund can be treated as opaque for one investor and can be treated as transparent for other investors. So you can have multiple outcomes. Now, there is a provision in the way Luxembourg implemented those hybrid rules, which is quite helpful for the fund industry, is where you have a situation where each investor owns less than 10% into the fund, they will be deemed not acting together. So that's kind of a helpful provision. Obviously, the tax authorities can prove the contrary, but there will be a presumption that if they are holding on an individual basis less than 10%, they will not be acting together for the purpose of that hybrid provision. So now, if we go to the payments that would be excluded as well from the hybrid rules, would typically be a payment that an entity would do to a zero tax country, such as the Cayman Island, for example. So that's indeed a deduction and a so-called no taxation on the other hand, but that does not result from a mismatch in the qualification of the payment. It simply results from the fact that Cayman does not operate a corporate tax system. Would also be out transfer pricing adjustment. So if there is a deemed deduction being claimed on one hand, where there's no deemed income being claimed on the other hand, that's just a matter of mismatch in transfer pricing regulation, but that has nothing to do with hybrid mismatches. And in principle, would not fall under the hybrid mismatches payments that are made to collective investment vehicle, the so-called CIV. But there is obviously a number of conditions to qualify as a CIV, one of which being widely held. So that does not apply to all investment fund vehicle. This closes our presentation about Luxembourg as a prime location for alternative investment. We hope you find it insightful. Please feel free to reach out to us. Our contact details are at the beginning of the presentation, and we look forward to a next session.